something has gone seriously wrong in America's economy, and few saw it coming. Policymakers, Wall Street, and even the Federal Reserve were unprepared. For years, the U.S. relied on massive stimulus, injecting trillions of dollars, printing money, and accumulating debt to keep growth afloat. Initially, unemployment fell, consumer spending surged, and markets stabilized. But now, those same measures are exposing deeper vulnerabilities. Inflation, long under control, has soared to levels not seen in decades, dramatically increasing the cost of living while wages struggle to keep pace. The balance between debt, currency value, and economic stability is unraveling, revealing cracks in a system once considered unshakable. While the United States grapples with these economic pressures, China is quietly maneuvering to strengthen its strategic position. Beijing has steadily accumulated vast amounts of gold, far beyond what is officially reported, holding it not only as an investment, but as a tangible asset to safeguard its financial sovereignty. Gold, unlike currency, is universally recognized, resistant to inflation, and insulated from the shocks of global markets, giving China a form of economic insurance against future crises. This accumulation aligns with a broader long-term strategy, reducing dependence on the U.S. dollar while building independent financial infrastructure capable of sustaining its growing global influence. At the same time, China has been methodically reducing its holdings of U.S. treasuries. For years, it held more than $1 trillion in American debt, stabilizing both economies and creating a mutually beneficial cycle. However, these investments carried significant risk. Shifts in U.S. fiscal policy, sudden changes in interest rates, or potential sanctions could threaten the value of China's reserves. By gradually trimming its treasury holdings, Beijing is carefully limiting exposure, ensuring its economy can remain resilient without triggering instability in global markets. In parallel, China's technological advancements are accelerating at an unprecedented pace. Companies in semiconductors, artificial intelligence, renewable energy, and advanced digital infrastructure are rapidly closing the gap with American competitors. Even some of the United States' most prominent tech firms have admitted that China is ahead in critical areas, signaling that the U.S. may no longer maintain unchallenged leadership in both global finance and technology. The convergence of finance and technology is now central to global power. Financial autonomy strengthens China's capacity to fund and control high-tech industries, while technological advancement reduces reliance on foreign systems and secures long-term economic sovereignty. These shifts have profound global consequences. Rising inflation, higher costs for essential goods, and potential currency realignments directly affect households, businesses, and governments worldwide. Countries from Russia to Saudi Arabia are exploring alternatives to the U.S. dollar for trade and reserves, while China establishes independent digital payment networks, cross-border settlement systems, and a digital yuan. These developments collectively challenge the dominance of the U.S. dollar and signal a shift in the balance of global economic power. For ordinary people, these changes are not abstract. They influence daily life. The cost of consumer goods, access to advanced technology, mortgage rates, and business financing may all be impacted by these evolving dynamics. Step by step, China is quietly reshaping the global order, reducing reliance on the U.S. dollar, securing financial stability through gold and digital systems, and simultaneously advancing technological self-sufficiency in key strategic sectors. The United States now faces a dual challenge: stabilizing its domestic economy amid mounting debt and inflation while maintaining global influence in both finance and technology. This is more than an economic story. It is a strategic struggle over the future of global power. The dominance of the U.S. dollar, once unquestioned, is increasingly being contested by gold, digital currencies, and diversified financial systems. Technology is also becoming a critical axis of influence, linking innovation directly to national power. Understanding these developments is essential. They show how carefully executed long-term strategies, both financial and technological, can reshape global dynamics. The future will be defined not only by policy decisions in Washington, but by strategic foresight in Beijing, and by how these two powers adapt to a more interconnected, multipolar world. The stage is set for a profound transformation, one that could redefine wealth, influence, and global leadership for decades to come. America's national debt has now ballooned past the staggering $30 trillion mark, and there appears to be no realistic plan to slow it down. Each successive round of stimulus has added more weight to a system already stretched to its limits. The Federal Reserve attempted to intervene by raising interest rates, hoping to cool inflation and stabilize markets. However, these rate hikes have come at a cost. They have made servicing the government's debt even more expensive. What has emerged is a dangerous feedback loop, one in which the very measures designed to save the economy are now threatening to destabilize it. Economists are increasingly describing this situation as unthinkable because the traditional tools of monetary and fiscal policy, once effective, now risk worsening the crisis rather than resolving it. The more the government injects funds into the system to stimulate growth, the more pressure builds on interest costs, inflation, and public confidence. Banks are under strain, markets are jittery, and even foreign investors, long confident in the stability of the U.S. dollar, are beginning to express concern. America's closest allies are quietly questioning whether this approach can be sustained and whether reliance on the dollar as the global reserve currency will remain viable in the long term. Some analysts warn that the stimulus program has reached a critical point of diminishing returns. The early benefits that came from aggressive money printing and cash disbursements to households have faded, leaving behind a landscape of high inflation, rising borrowing costs, and fragile consumer confidence. The economy now appears dependent on constant injections of liquidity, and without them, growth risks stalling almost immediately. Yet continuing stimulus comes with its own dangers, potentially igniting further inflation or even triggering a full-blown debt crisis. Beneath all these concerns lies a deeper, more existential fear that the United States may have crossed a threshold where its policy measures no longer rescue the economy, but actively contribute to its instability. Amid this turbulence, another global player is moving with deliberate precision: China. While Washington debates interest rates, fiscal deficits, and debt ceilings, Beijing has quietly embarked on a parallel strategy designed to secure long-term financial sovereignty. Central to this plan is the systematic accumulation of gold. Month after month, China's central bank, the People's Bank of China, PBOC, continues to add vast quantities of gold to its reserves. While official reports suggest holdings of over 2,000 tons, independent analysts believe the actual total may be much higher, potentially double or even triple the reported figures. The PBOC often conducts purchases through state-owned banks or overseas channels, allowing the country to amass hidden reserves without attracting public scrutiny or destabilizing global markets. This is no arbitrary or impulsive buying. It is the result of a long-term strategy spanning more than a decade. While the West concentrated on digital currencies, complex derivatives, and speculative financial instruments, China doubled down on something enduring and historically proven: gold. To Beijing's policymakers, gold is far more than a simple commodity. It is a tool of power and stability. Unlike paper currencies, gold cannot be printed, artificially manipulated, or frozen by foreign governments. Its intrinsic value persists even during global financial crises, currency collapses, or geopolitical shocks. By stockpiling gold, China is effectively constructing a shield against the volatility of the U.S. dollar, hedging against inflation, sanctions, and the unpredictable fluctuations of global markets. The timing of this strategy is deliberate. The U.S. dollar still dominates international trade, finance, and reserve systems. But this dominance carries increasing risk. Every interest rate adjustment, every expansion of stimulus spending sends ripples through global markets, impacting nations holding dollar reserves. These countries are exposed to monetary policies they cannot control, and China is acutely aware of the vulnerabilities this creates. By converting a portion of its foreign reserves into gold, Beijing is securing financial independence while simultaneously sending a subtle but powerful signal to the rest of the world. Real assets, gold, may once again dictate global economic power. The scale of China's gold accumulation is unmatched. Every PBOC report highlights hundreds of thousands of ounces being added to state vaults. The pattern is relentless, methodical, and strategic. Other nations, such as Russia and India, have adopted similar approaches. but none match the speed or magnitude of China's program. Analysts also suggest that Beijing leverages its Belt and Road partners to access additional gold sources in Africa, Central Asia, and the Middle East. This is not simply about accumulation, it is about controlling supply, creating strategic reserves, and solidifying long-term financial resilience. In essence, while America struggles with debt, inflation, and the limits of conventional economic tools, China is quietly reshaping the global financial landscape. Its gold strategy, combined with broader economic initiatives, reduces dependence on the U.S. dollar, strengthens financial autonomy, and positions China to wield greater influence in the emerging multipolar world order. The implications of this shift extend far beyond national borders. It challenges the established dominance of the U.S. dollar, recalibrates global power dynamics, and underscores the growing importance of tangible assets in securing long-term economic stability. Control over production, pricing, and access to financial resources has always been central to global economic influence. While Western central banks have largely maintained their gold reserves at stable levels for decades, China has emerged as the dynamic player quietly rewriting the balance of power, ounce by ounce. The G7, short for the Group of Seven, represents the world's most advanced industrial economies: the United States, the United Kingdom, Canada, France, Germany, Italy, and Japan. Historically, these nations have dominated global finance, setting the standards for monetary policy, trade, and international banking. They control the largest central banks in the world and collectively hold a massive portion of global gold reserves. The United States alone possesses over 8,000 tons of gold stored in secure facilities such as Fort Knox, while European members, including Germany, Italy, and France, each maintain reserves exceeding 2,000 tons. These holdings have symbolized not only wealth, but trust, the backbone of the post-World War II financial system built around the U.S. dollar. However, beneath this apparent stability, a quiet yet profound shift is occurring. China, along with a number of emerging economies, is steadily narrowing the gap in gold accumulation. While the G7 continues to dominate in total reserves, the pace at which China is adding to its holdings is unprecedented and unmatched. Month after month, China's gold reserves grow, while the G7's levels remain largely unchanged. Beijing's strategy is deliberate and calculated. Acquisitions are substantial, strategic, and consistent, rather than sporadic or reactive. China is not alone in this movement. Other nations previously considered followers of Western financial norms, such as Russia, India, Turkey, and even some Middle Eastern economies, have begun to increase their gold holdings in a bid to reduce dependence on the Western banking system. This trend has introduced a new dimension to global economic power, prompting unease among traditional Western powers. When analysts say that China is snatching gold reserves from the G7, they do not imply literal theft, but a reallocation of influence and financial leverage. The global gold market is finite. Aggressive purchases by China and its partners absorb supply that previously might have flowed to Western vaults. More importantly, these purchases shift the psychological center of power. Gold is far more than a commodity. It is a tangible symbol of financial independence, stability, and sovereignty. Each ton of gold China adds undermines the long-established dominance of the U.S. dollar as the ultimate global reserve currency, quietly chipping away at the foundation of the dollar-led system. This quiet gold race underscores a broader transformation in global financial architecture. By diversifying away from reliance on the dollar, nations are seeking a hedge against political risk, sanctions, and the concentration of financial power in the hands of a few Western nations. Historically, the G7 has exercised unparalleled authority over international money flows, dictating the rules of trade, currency valuation, and monetary stability through the dollar, euro, pound, and yen. However, as more nations convert parts of their reserves into gold or conduct trade in their own currencies, the once rigid hierarchy of global finance is beginning to loosen. China's accumulation strategy signals a long-term goal, not to immediately surpass the G7, but to create a foundation for an alternative financial ecosystem in which the yuan, supported by tangible assets such as gold, can compete on equal footing with Western currencies. The balance of global reserves is slowly tilting. With each additional ounce added to Beijing's vaults, the traditional order feels increasingly less permanent. For For the United States, the fallout from its massive stimulus spending is becoming ever more visible. Trillions of dollars injected into the economy over the past decade have left behind a mountain of debt that now consumes an ever-growing portion of the federal budget. Interest payments alone are absorbing funds that could otherwise be spent on critical infrastructure, defense, or social programs. Inflation, though easing slightly in some sectors, continues to erode the purchasing power of ordinary households, creating a growing squeeze on middle-class families. The dollar, once perceived as invulnerable, is now showing signs of fatigue. Investors are increasingly questioning how long America can maintain its borrowing and spending policies without triggering serious consequences. The United States now faces a shrinking margin for error. Fiscal space to respond to future crises is limited, and traditional tools for restoring confidence in the financial system are less effective than ever before. Meanwhile, global markets are reacting predictably but powerfully to this uncertainty. Gold prices have surged as investors seek safe, tangible assets immune to the volatility of fiat currencies. Central banks across Asia, the Middle East, and even parts of Europe are ramping up gold purchases, following the lead set by China. This growing shift toward hard assets reflects widespread anxiety over the reliability of the dollar and the long-term consequences of U.S. fiscal and monetary policies. This evolving dynamic is more than a simple rearrangement of reserves. It represents a reconfiguration of global influence. China's methodical accumulation of gold, coupled with strategic partnerships and Belt and Road initiatives, signals a multi-decade plan to secure financial autonomy, mitigate risk from foreign policy pressures, and position itself as a central player in a world less reliant on U.S. monetary dominance. While the G7 continues to command significant reserves, the rapid pace of change in gold accumulation demonstrates that the balance of power is no longer static. Countries that hold real assets, diversify reserves, and control critical financial infrastructure will increasingly shape the rules of global commerce, investment, and trade in the decades to come. In essence, the quiet accumulation of gold by China is a deliberate, long-term strategy that reflects foresight, prudence, and ambition. It challenges the assumptions of a U.S.-dominated financial world, reshapes perceptions of economic power, and signals a broader transformation in the global hierarchy. Each ounce of gold is not merely a financial asset. It is a tool of influence, independence, and resilience in an increasingly multipolar world. As Beijing continues its steady march, the traditional order feels ever more fragile, demonstrating that the rules of global finance are no longer immutable and that the future of monetary power may be quietly shifting eastward. Some countries are now exploring innovative ways to conduct international trade using local currencies, commodities, or even gold itself, aiming to reduce exposure to the volatility of the U.S. dollar. What began merely as a quiet diversification of reserves is gradually transforming into a significant realignment of global financial power. The traditional center of gravity, long anchored in Washington, appears to be shifting eastward, 1 ounce of gold at a time. China stands at the forefront of this transformation, and the benefits it reaps are substantial. By steadily increasing its gold reserves while simultaneously reducing reliance on the dollar, Beijing secures greater financial sovereignty. This autonomy allows it to act more freely on the global stage without the constant threat of sanctions or foreign pressure influencing its decisions. Holding substantial gold reserves also strengthens China's credibility in international finance. It signals to investors, trading partners, and other nations that the Chinese yuan rests on a tangible and stable foundation rather than being solely a fiat currency subject to political whims. This approach aligns with China's broader ambition to internationalize the yuan and challenge the dollar's long-standing dominance in global trade and finance. As China's influence grows, it gains the ability to shape market dynamics, set transaction terms, and develop a financial system that reflects its strategic interests rather than those of Western powers. This transformation is not just financial. It represents a subtle but powerful shift in geopolitical influence, where economic sovereignty and strategic positioning intersect. Yet significant uncertainties remain. The full scale of China's gold holdings remains opaque. A portion of its reserves is hidden within state-owned banks or managed through sovereign wealth funds that do not disclose detailed information. This lack of transparency leaves analysts speculating about China's true financial power and raises questions about how global markets might react if hidden reserves were ever fully revealed. If the actual quantity of gold is significantly larger than official figures suggest, the disclosure could produce profound ripple effects across currencies, commodities, and bond markets worldwide. Despite this opacity, evidence indicates that China's appetite for gold shows no sign of slowing. Month after month, the People's Bank of China continues to expand its reserves, marking one of the most consistent and prolonged sequences of gold accumulation in modern history. While official reports show steady growth, experts believe the real total is far higher, with many acquisitions conducted discreetly through state channels or investment vehicles that remain largely invisible to global observers. This disciplined, continuous accumulation starkly contrasts with the United States, which still holds the largest gold reserve in the world, more than 8,000 tons, but has added virtually nothing to it for decades. While American gold remains static, symbolizing historical strength, China's ongoing purchases reflect a forward-looking strategy designed to build tangible financial foundations for the future. The contrast is telling. The U.S. relies primarily on the trust and dominance of its currency, while China is systematically turning each gold purchase into a foundation of real, measurable wealth capable of underpinning long-term strategic influence. As each quarter passes, this strategy becomes increasingly visible. If China maintains its current pace of accumulation, while the United States continues to struggle with mounting debt, inflationary pressures, and fiscal uncertainty, the balance of global financial power could tilt dramatically. A weakening U.S. economy, hampered by endless borrowing and persistent inflation, would likely reduce the appeal of the dollar as the world's primary safe haven asset. In this scenario, gold could surge to unprecedented levels as nations, investors, and institutional funds rush toward it for security. China, with its growing stockpile, would be positioned as a central influencer of both the gold market and perceptions of real value for nations heavily reliant on the dollar system. This potential shift may trigger increased volatility in global markets and possibly signal the start of a gradual retreat from dollar dependence. Meanwhile, emerging economies are carefully observing these developments and recalibrating their strategies. Countries across Asia, Africa, and Latin America are diversifying reserves, purchasing gold, and forming trade alliances that operate independently of the U.S. dollar. This is not an effort at confrontation, but rather a protective measure designed to shield national economies from the cascading consequences of U.S. policy missteps. Gold, which for decades was seen as a relic of the past, is regaining its role as a central pillar of trust and stability in global trade. It is becoming a critical tool for balance in an increasingly unpredictable financial system. China's approach demonstrates how strategic accumulation of tangible assets can serve as a counterweight to traditional currency dominance. As more nations follow suit, the world is entering a period where gold reclaims its historical significance, not as a mere symbol of wealth, but as a key element of a new financial architecture. The patterns unfolding today suggest the early stages of a shift that could redefine global economic relationships for decades to come, affecting trade, investment, and geopolitical influence on an unprecedented scale. This story is more than just a chapter in global economics. It represents a profound transformation in power structures, strategy, and influence. By steadily amassing gold while strategically reducing dollar exposure, China is reshaping not only its own financial position, but also the rules and foundations of the international system. The implications extend far beyond numbers on a balance sheet. They touch the very mechanisms of global trade, the security of national economies, and the distribution of economic power in a rapidly evolving world. Each ounce of gold added to China's reserves signals a deliberate, long-term vision for financial sovereignty and strategic influence that could challenge decades of Western dominance. The emerging picture is clear. The world's financial center is gradually shifting eastward, led by a methodical, persistent, and highly strategic accumulation of tangible wealth that could define the next era of global economic order. The United States is now grappling with the unintended consequences of its massive stimulus strategy. Skyrocketing debt, a weakening dollar, and declining confidence in the stability of its financial system are all raising red flags for policymakers and global investors alike. Meanwhile, China is quietly executing a long-term, disciplined plan to reshape the international financial order. Its ongoing accumulation of gold is about far more than simple wealth. It is a deliberate strategy to gain influence, control, and strategic leverage over global finance. Together, these two forces, America's overstretched stimulus policies and China's methodical gold purchases, are driving one of the most significant shifts in the global economic landscape in decades. Each month of gold acquisition, every spike in inflation, and each new trade agreement signals a world where power may no longer rest with those who print the most money, but with those who hold tangible value when instability strikes. Gold and reserves are quietly reclaiming their historic role at the center of global influence, reshaping long-established hierarchies. To understand the coming era, watch how the U.S. economy responds, track China's central bank moves, and observe how other nations adapt. The clues to the next global order are already emerging, and those paying attention can anticipate the changing balance of power,